Hello, everybody. Doing this weekly tax planning video. Today, I want to talk about itemized deductions. So we all hear about different things that are deductible on our taxes, such as state taxes, mortgage interest, medical expenses, and so on. These are what we call itemized deductions. And um, you on your 1040, your individual tax return, you can either itemize or you can take standard deductions. You can't do both. And let me just pull up a quick 1040 here to show what I'm talking about. So let me go ahead and share screen. Make sure I'm not going to show anything I shouldn't show. Okay, share screen. Okay, so we're looking at a 1040 here, and where we take the standard deduction or the itemized deduction is right here on line 12. And so we can either standard or itemize. And we'll go into the itemized deductions here in a minute, but here are the rules for a standard deduction. It's either 12,000, and this is what return. So this is 2022. So everything's inflation adjustment. So it's actually gone up for 2023 some, but for 2022, it's about $13,000 single, about $26,000 if you're married, head of household, 19. And basically, if you're married filing separate, it's the $13,000 as well. So those are the standard deductions. So if you're going to itemize, you have to have itemized deductions greater than these limits. Otherwise, we're going to use the standard deduction, right? So it's either or. We can't do both. Married filing joint, in order to itemize, you have to have itemized deductions greater than $26,000. And I think it's actually a little higher than that for 2023. All right, so that's the big thing there, a standard deduction or itemize, and you have to be above these thresholds before we're even going to itemize. Well, what is itemizable? So I just did a quick Google search, and this is TurboTax. And I mean, it's all the same. So the first thing is mortgage interest. And that's on up to 2 homes. And the actual limit there is up to $500,000 of loans. So technically, if you have $1 million in a home loan on 2 different homes, you can actually only take it up to 500,000. So we have to allocate that. So that's limited. Your state and local income or sales tax. Well, Trump's tax law, one of the negotiations they did was that gets limited to $10,000. So you can't take $10,001. So if you have property taxes on that $1 million home that is greater than $10,000 plus income tax, then you don't get to take more than that $10,000. And that calculation takes into account income or sales tax, whichever one's greater, and your property taxes, because state and local taxes are limited to $10,000, and property tax is a local tax. Okay, so mortgage interest, limited. State and local taxes, limited. And then we get medical and dental expenses that exceed 7.5% of your adjusted gross income. So if your adjusted gross income, well, what does that mean? Basically your taxable income. Now it's a slight different calculation, but pretty much the same idea. So if you have $100,000 of taxable income, meaning let's say you have a W-2 for $50,000 and you have a $50,000 profit in your S corporation, you have $100,000 of adjusted gross income. That means you have to have medical expenses greater than 7.5% of your adjusted gross income. And so if you only have $7,500 of medical expenses, they're not deductible. You have to have $7,501 in medical expenses for them to be deductible, and then you only get to deduct that $1. So now medical expenses are limited. And charitable donations, they're limited to 50% of your AGI, your adjusted gross income. So most people don't make if you have $100,000 of AGI taxable income, and you have $100,000 of charitable contributions. I don't know how you would make that work. I guess you're living on debt. You'd only get to deduct 50% of it. So you would only get $50,000 of charitable contributions. So everything is actually limited on the itemized deductions. There used to be, prior to Trump's tax law, we had what was called miscellaneous itemized deductions, which were subject to 2%, limited to 2% of your AGI. So you had to have over $2,000 for $100,000 of taxable income. You had to have over $2,000 in miscellaneous items in order for them to be deductible. Typically, those things were stuff like investment advice and fees for like stocks and bonds, or out-of-pocket employee expenses. So if you're a traditional day employee working for somebody else and you had to buy like a uniform, that would count. Stuff like that. All that stuff is gone until Trump's law expires. And I'm actually going to do a video in the next few weeks about the expiration of Trump's tax law and how that's going to affect everyone, because that's supposed to expire in 2025. So that's coming up relatively fast. And so there are some things that we're going to talk about that will cause us to have raised taxes unless that law gets extended. As of right now, it's probably not going to get extended. Who knows what will happen in the next couple of years, but we'll talk more about that in another video. Right now, I just want to talk about itemized deductions. So these are our itemizable expenses: mortgage interest, state and local taxes to include property taxes, medical expenses, and charitable contributions. Now, everything that's on there is limited. That's horrible. We don't like that. And if we don't have more than our standard deduction, they actually just disappear and we take the standard deduction. So that's why I talk about how do we legally double dip. And the way we do that is we move all of these expenses to our business. We make them all business expenses. Most of that is through our employee benefit program. But for example, mortgage interest and property taxes, usually the two biggest itemizable expenses are your mortgage interest and property taxes. That's usually what will get people into itemizing if they have a large enough house, or large enough house, high enough property taxes with a large enough mortgage on it. Now, what we do is we take a home office deduction, and we get aggressive on the home office deduction. So we say, hey, you know what? 20, 30, 40, 50, 60, up to 90% of our home is used for business. So then, we're taking 50% of our mortgage interest and 50% of our property taxes and making them a business expense. All right. State and local income taxes, there's not a whole lot we can do about that. One of the things that a lot of the states did was they passed what's called pass-through entity tax. And so instead of paying your state tax for your business at the individual level on your 1040, you now pay it at the corporate level in your S corporation to make it a business tax as well. So now that was how a lot of states have combated that $10,000 state tax limit. So we've moved mortgage interest to the business, we moved state income tax to the business, we've moved property taxes to the business. Well, medical and dental expenses, that could be anything in medical health related. So that's your insurance premiums, that's your copay, your deductible, and any out-of-pocket expenses. And as we've talked about, hopefully we call that employee benefits. And so 100% of all out-of-pocket medical and dental expenses is now a business expense. So we write that off through the business. Then the last thing is charitable donations. So a couple of years ago, this has been up in the air a lot, but finally the Supreme Court took on a case and they ruled that a business is incapable of making charitable donations because everything a for-profit business does by definition has to be for-profit. So if a business does charitable donations, it is considered advertising expense. We now run this through as advertising expense. The only exception to that is a charitable donation made specifically to a church as tithing. But if it is made to a church for other purposes, for example, maybe your church is doing fundraising to build a new playground for its preschool or something, or you're sponsoring you're donating to the local Boy Scout troop that is sponsored by the church organization or something like that, that's still considered advertising expense. But if you are literally paying tithes or tithing to a church, that is always considered personal and falls into the itemized deductions. So now we've moved all charitable contributions to the business. So now we're taking all of these expenses in your S corporation, which means we've now made you have less taxable income in your business. But because we've moved them all to the business and it's taken in that S corporation tax return, now we don't have enough to itemize, and so you get the standard deduction. And so this is how we legally double dip. And if you've watched my how our S corporations tax, you will know that we have our revenue minus our expenses equals taxable profit out of an S corporation. Well, then that moves right into the 1040 into this adjusted gross income bucket. And so then we say, okay, all these mortgage interest, state taxes, property taxes, medical expenses, and charitable contributions that were expenses in the S corporation, lowering your taxable profit, just got moved over into your AGI, your adjusted gross income bucket. And then we throw in that standard deduction underneath that, then lowering your adjusted gross income into taxable income. And that's how we legally double dip. So when you hear people say, oh, that's itemizable, oh, medical expenses are itemizable, oh, definitely take this as an itemized deduction. Really, we need to pay for it through your business because we are going to make it a business expense so that we can still take advantage of that standard deduction. And because the standard deduction is so high, for the last 10 years that we've had the Trump tax law, very, very few people actually itemize. And again, I'm going to talk about the retirement or the sunsetting of Trump's tax law in 2025 and how it's going to affect a lot of people, meaning a lot of people are going to start itemizing again. Right now, the standard deduction is so high that nobody itemizes because you have to have a pretty large home with pretty high property taxes and pretty high interest before you're even capable of itemizing, or you make a huge charitable donation to something. Those are pretty much the only people that itemize right now. But we try to legally double dip by moving all of these to the business. We create a business expense, and then we still take the standard deduction too. Anyway, so that's a quick tax planning video on itemized expenses versus I'm going to end really fast. My Roomba decided to come vacuum right here. But anyway, quick summary, itemized expenses go on the business, pay for them with your business bank account. We record them in QuickBooks as either employee benefits or a home office deduction or something. I guess property taxes and the interest, mortgage interest, we put on the reimbursement sheet because it is a home office deduction. But that is how we legally double dip on those itemizable expenses. Anyway, thank you and have a wonderful week.